Hey, everybody, I got a great topic and a guest. This is going to be fantastic. So, I was reading some articles. I was actually just at a conference with Dave Ramsey and listening to him speak, and ran across an article where he really trashes on gold. And obviously, now that gold has jumped to over 5,000 an ounce, it seems a little archaic in his thinking. But I wanted to really kind of drill down and look at this with one of the experts in the industry. So, the big five reasons that I commonly see out there that Dave Ramsey illustrated was a good place to start. So, introducing Greyson Geiller. He is with us today, and I wanted to address each of these five and see his take on them. So, the first one, Greyson, is gold's long-term performance lags productive assets. He specifically pulls out, just like he does with the stock market, the entire history of
Mhm.
the stock market. It's averaged 12%. Well, gold has a lousy 70-year track record with low average annual returns.
Yeah.
Well, he did say this back when it was 3,000 an ounce, not over
Yeah.
5,000 an ounce. But even at that, what's your perspective on this?
You can cherry pick time windows where one investment is wildly better than the other. I didn't see Dave's comment 70-year track record. I did see him track gold since 1980 because, of course, that was a high print in gold and a low print in the stock market, and he compared it to the stock market. If you compare gold to the S&P 500 from the year 2000, gold has wildly outperformed the S&P 500 since 2000. You go back to when it became legal for US citizens to own gold again, and the compound annual growth rate is right about 9% since 1971. So Dave, it competes well with the S&P 500, and there are time windows when it does wildly better.
Yeah, that I see that as a common mistake all over the place. I can make anything look great just by
Yeah,
cherry picking
cherry
the
pick the
dates
dates.
to use. And
Yeah,
I've always argued for, especially when using stock market information, kind of that turn of the century, 2000, because we've digitized all of our stock markets,
yeah,
and the volatility hits record new highs every year since 2000, just because the speed of trading and everything else, we've
yeah.
modernized it and it moves a lot faster. So it's a fundamentally different market. So I think that's a great way to look at it. I always tend to start at 2000 for my information. So the next one is gold is volatile and driven by fear. Prices are driven by fear and greed rather than intrinsic value, making it a speculative gamble, not an investment. And I always laugh when I see that because that's kind of how I feel about the entire stock market. But
Yeah.
let's hear your take on this.
Well, the only thing Dave's really right on with that comment is that gold isn't an investment. I mean, it's really the international currency. But when you talk about price movements of pretty much anything, they're driven by fear and greed. The gold has some volatile times, but take a look at the S&P 500 last April. S&P 500 lost 20% in a month. S&P 500 lost 30% in 1 month in 2020. Well, that's an investment. Gold, when times are bad, people can run to gold, and there can be some price movement. At the end of the day, Dave, it made a new all-time high yesterday. So
Well, I agree. And part of diversification is finding
that's right.
assets that move not together with all the other assets. They call them uncorrelated investments. And yes,
Well,
you say it's not an investment, but I still look at it as a currency play and an investment because the reality is anything that I buy that has a ability to rise in value is an investment. And
and it's
so
a diversification from the US dollar.
yeah.
Absolutely.
All right, so the next one, practical hurdles and hidden costs undercut the appeal. Purchasing physical gold involves dealer premiums, while holding it requires secure storage and insurance eating into the potential profits.
Okay, that's a legitimate comment. As time goes on here, those prices are coming down. Gold is coming back into the mainstream investment world. So a lot of people will buy GLD is an ETF on the New York Stock Exchange. But there are gold savings accounts now that you're not paying for storage. You log in and you see digitized representation of how much gold you own. There are a lot of cryptocurrencies now that are backed by gold to enable people to go spend it. So legitimate comment, but 10 years old. I mean, those prices are coming down. Premiums, I don't know, Dave, you used to refer people to A-share mutual funds that had a front load of 5%.
Yeah, it's almost like he thinks the only way to own gold is go buy the physical gold and then
Yeah,
pay somebody to store it and insure it. And
yeah.
there are so many more ways to invest in gold, even the physical, because the argument against GLD is you don't actually own gold. You just own an investment that follows the price of gold minus the fee. Whereas there's a lot more choices out there nowadays.
There are a lot of ways to own it that you're not paying big storage costs or upfront premiums to buy into.
And that's the great thing about quote unquote efficient markets. The more competition, the less
Yep.
cost, the more options people have. All right. So this one I find interesting and for me absurd. I would get on a pedestal and talk on this every day of the week if I could. Ineffective inflation hedge. While often promoted as a hedge, Ramsey argues that other assets like real estate offer better protection against inflation.
Well, first of all, I would say if you want, I'm not sure what he means by inflation hedge. I mean, inflation it always exists in the monetary system that we have. So it's pretty much diversification of different assets that you own, Dave. So I wouldn't put every dollar that I own in real estate. I certainly wouldn't put every dollar that I own in gold. You have to have diversifications. There are a lot of differences between real estate and gold, though, in general. Gold is divisible, it's fungible. An ounce of gold in London is the same as an ounce of gold in New York. Obviously, not the case with real estate. So, wildly location specific. You can't divide your cabin in the mountains into tiny little pieces the way you can gold. You can't put it in your pocket and carry it away. And there's no county commissioner charging taxes on your gold holdings. So one's a financial asset, and the other one is real estate. It's a physical asset. So lots of differences, and not a very good apples and oranges comparison, if you ask me.
Yeah, I immediately had a reaction to this, and it's not because I think gold is a perfect inflation hedge. It has nothing to do with that. I'm building a class on combating inflation in retirement, and it's about that diversification. It is about owning real
Yeah.
estate. It is about owning gold. It is about owning stocks. You do
Well,
have to have
I'm sorry to cut you off, but that's a funny point right there. I'm a huge advocate of gold, and I would never throw real estate under the bus and say owning real estate is stupid. Owning real estate is great.
Yeah, yeah, fantastic. And that's the well-rounded portfolio, not
Yeah,
just in good growth stock mutual funds. You can't rely on just one
that's right.
type of asset. And so that's the idea of diversification to combat inflation. And that's a big topic because there are economists and experts everywhere saying we're really building to an inflation bubble, and we've got that to deal with in our somewhat near future. And so, if you think inflation is done, we already had our little 9% inflation year. I got news for you. We got more coming, and there's
Agreed.
a lot of reasons for it. All right, the last one. Gold does not generate income. That's not just Dave Ramsey. I think your buddy in
Warren
Omaha
Buffett.
also said that too.
Yeah.
Gold is considered a rock. Not really. That just sits there. It pays no interest or dividends, making it ineffective for building long-term wealth. And as you said, I mean, a 9% annual return, is that not something that grows and builds wealth? Well, okay. But talk to me about what's going on in this gold world, and why do people keep saying it has no dividends or interest?
Well, that's Dave Ramsey not paying attention, plain and simple. Central banks, bullion banks, large institutions have leased and loaned their gold out forever for a rate of return. As far as individual investors, over the last decade, there's a transparent private marketplace, leases and bonds denominated in gold and silver. Mom and pop investors, institutional investors are owning gold, leasing and lending it out for a rate of return, and it's very consistent. So that's Dave not paying attention. The one interesting thing, though, when you look at the financial world, and like you're talking about, people are pretty nervous about paper currencies around the globe. Well, nobody's going to tell you exactly how much gold they have, but estimates are there's probably $6 or $7 trillion worth of gold in people's basements and safes and in their freezer or wherever it may be. And this marketplace of leases and bonds, where people are depositing gold and getting an interest rate on it, is exploding. I mean, that's why I started my fund. I have a fund that we buy gold and silver, actual physical, and we deploy it into leases and bonds, and we're earning great interest rates. So maybe I'll call Dave. I'll see if he wants to invest in my fund.
Sure, sure. Yeah, and I've seen some of the results of this fund. It's been phenomenal, not just because the price of silver and gold has rocketed, but the fund beating GLD,
Yep.
the ETFs out there, by 4, 5, 6%. It's kind of crazy. And the reality is that doesn't rely on gold and silver going up or down. You're always going to be beating that because you are lending and leasing it out. And so it's a pretty fantastic marketplace,
Yeah, and I
allowing
tell
people.
investors for a portion of their portfolio, just think in terms of ounces. And rather than having ounces of gold or silver sitting in your safe, why don't you deploy those ounces to a mechanism that you're going to earn more ounces? You want to check the dollar value of those ounces down the road, that's fine. But for a portion of your portfolio, just think in ounces terms and keep acquiring more ounces, and the dollar value of it will take care of itself as time goes on.
Great, great. So the name of your fund is the
The
Gold Rush Yield Fund.
Gold Rush Yield Fund. Yep.
And how do we get a hold of you?
Hey, just you can call the 800 number on there or email Scott, and he'll forward your email to me. And this isn't a solicitation for investment, because I don't know anyone who's listening's specific financial situation. But for certain individuals, it's a great tool, inflation hedge, diversification of their portfolio, however you want to look at it.
Yep, those wonderful regulators. All right, contact me if you want some more information on this one. Hope that helps. I'm here every single week with new content for you. We've got a new video coming up next week. So visit yourinvestmentcounselor.com to schedule an appointment with either of us. I've got Greyson on there, yourinvestmentcounselor.com. And full classes, if you haven't found them, I've got a couple of months. The topic is the inflation topic. So building that education right now, fpfeaz.org. Greyson, thank you so much. And we will see you all next time. Thanks again.
Thanks, Scott.